In the last several years, we've pitched well over 1,000 investors and VCs to raise over $37 billion for low to mid-market companies, including 27 startups. And I only really started to get investors to say yes after I learned what I actually needed to focus on. So in this video, I'm going to condense decades of pitching experience and more than 1,000 investor meetings into 44 tactical lessons that you can implement today to secure more meetings, impress investors, and close your funding round, most importantly. So if you're ready, let's go. Number one, build momentum before you pitch. Most founders flip a switch and suddenly start asking for money. This is stupid. Investors don't back cold opportunities, they back momentum. Before sending any deck, create noise in the market, get on podcasts, write industry articles, post customer wins on LinkedIn. Even small PR hits compound into credibility. When you finally pitch, the investor already sees you moving. Their decision becomes simple: hop on this moving train or miss it. That's infinitely stronger than asking them to help you get started. Momentum sells, desperation doesn't. Number two, nail your one-liner first. If you can't explain your business in one sentence, your deck will not save you. So please stop using fluff like revolutionizing the industry. Use this formula instead: who you serve, what you do, proof it works. Here's an example. We help medical clinics increase revenue 34% using AI billing automation. It's clear, specific, credible. Test this line until people immediately lean forward when they hear it. Everything else builds from this foundation. Number three, lead with tax benefits. Rich investors obsess over after-tax returns. If your deal qualifies for QSBS, opportunity zones, or other tax structures, lead with that. I've literally watched investors choose 12% tax-free over 20% taxable deals. They don't just want to make money, they want to keep it. So put tax efficiency front and center in your pitch. It's honestly the secret weapon that most founders ignore. Number four, kill your fundraising voice. So desperation stinks through Zoom calls. We could agree on this, yes? Stop sounding like you're begging for scraps. It's a rookie mistake. Here it is. This is a once-in-a-lifetime opportunity. You have to act fast. Instead, flip your posture completely. You're choosing partners. You're not chasing checks. Stay calm, confident, measured. Money chases strength and runs from neediness. Control the frame from minute one. Number five, recycle your list every quarter. A no today doesn't mean a no forever. Fund priorities change, partners rotate, investment mandates shift, money opens up. So every 90 days, hit your investor list again with fresh traction updates. By the third touch point, you're not a stranger anymore. You're a company they've watched consistently progress. This breeds trust and eventually checks. Okay, number six, frame like you're already moving. Even if you've only raised 20%, say something like this: we have strong early commitments and we're selectively opening space for 2 to 3 more strategic partners. Nobody wants to rescue a dying company, let's face it, but everyone fights for seats on rocket ships. So this subtle reframe, it absolutely changes everything. Confidence is magnetic and desperation repels money. Number seven, practice on tier 2 investors. Let's be honest, you are going to mess up your first few pitches. It happens to everyone, guaranteed. No problem. You're going to stumble on numbers, realize slides are weak, forget key points. It's normal. That's exactly why you never start with dream investors to begin with. Start with your second tier targets instead. Let them absorb your mistakes. By the time you reach top tier VCs, you'll be polished and battle tested. Number eight, make slide one explosive. Your opening slide determines if investors pay attention or check email. Don't waste it on company logos or generic mission statements. Lead with your most compelling traction metric. Make them stop what they're doing and focus. The first impression becomes your last impression. Number nine, answer why you, why now immediately. Every investor silently asks these questions within 60 seconds. If new regulation just opened your market, highlight it early. If you have unique domain expertise, prove it up front. If market timing is perfect, show the data. Don't bury your competitive advantage on slide 12. Strike while you have their attention. Number 10, test hooks on random people. Now, before pitching any VCs, DM your one-liner to 15 strangers on LinkedIn. If nobody responds with "tell me more," your hook is broken. If random people immediately want details, VCs will too. Use the broader market as your testing ground before risking your reputation with investors. Number 11, master 3 email sequences. Most founders send one long email and wonder why they get ghosted. Think in campaigns instead. Email 1, hook their attention with traction. Email 2, add social proof and validation. Email 3, remove all friction to respond. This sequence dramatically outperforms single-shot outreach every single time. Persistence with purpose wins deals. Number 12, build your golden Rolodex now, not later, now. Start cataloging everyone who could potentially introduce you to investors, LinkedIn connections, podcast hosts, satisfied customers, industry contacts. Touch base with these people monthly with valuable updates. Keep relationships warm before you need them. When fundraising time comes, you'll have a ready army of potential connectors. Number 13, use voice notes in follow-ups. It's a rarity, but it's really cool. A 20-second personalized voice message cuts through inbox clutter like nothing else. It sounds human, urgent, and authentic in ways that text never can. People might ignore your email, but they'll listen to your voice, and it humanizes you. This one simple tactic dramatically increases response rates on follow-up messages every single time. Number 14, one-click meeting scheduling. This is huge, you guys. Investors won't play calendar ping pong with you. They just won't. Use a clean scheduling link with pre-filled time zones and one-click booking. Every additional step in your process absolutely kills conversion rates and momentum. Don't do it. Make saying yes as frictionless as possible. This small detail books significantly more meetings with the right investors. Number 15, eliminate all jargon. For God's sakes, please. Smart investors hate buzzword bingo more than anything. Don't say AI-enhanced Web3 optimization layer for next-gen solutions, blah, 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 blah. Say software that reduces fraud by 40% for e-commerce companies. If a fifth grader couldn't understand your description, rewrite it immediately. Clarity always beats cleverness in fundraising every case scenario. Number 16, document your process. Limited partners invest in systematic approaches, not chaotic founders. Even if you're small, act like a disciplined fund manager. Show repeatable processes for deal sourcing, due diligence, and performance tracking. Investors want predictable systems, not brilliant chaos. Make your approach feel institutional and reliable. Number 17, ask for feedback, not money. Can you invest in our round? Immediately raises defensive walls. Duh. How about, would love your feedback on our fundraising strategy. That opens doors instead. Get them intellectually engaged first through consultation. These feedback conversations naturally evolve into investment discussions once they're emotionally committed to your success. Remember that. Number 18, master the mini deck. Create a 3-slide version. Vision, traction, market size. Embed these directly in email bodies, never as attachments. Investors hate opening PDFs from unknown founders. Please don't do that. This mini deck format sparks curiosity and gets you actual phone calls instead of polite rejections or ghosting entirely. Number 19, drop mutual connections. Let them know. So for instance, I noticed you follow John on LinkedIn. He's a buddy of mine. We work together at XYZ company. That's going to double your response rates immediately. Even weak social ties create this familiarity and reduce skepticism. Use every connection you have, no matter how distant, because warm introductions beat cold outreach every case scenario. Now, number 2, stop talking like a tech bro. VCs hear disruption and world-changing innovation literally hundreds of times a week. What actually cuts through the noise? Clarity, specifics, humility. Go figure. Be the rare founder who explains complex ideas simply. You'll immediately stand out from the buzzword crowd. Number 21, create allocation scarcity. Don't say we're raising $2 million. Instead, say we're opening a $2 million allocation with $1.5 million already soft circled and 3 spots remaining. Investors desperately want deals that feel exclusive and competitive. This scarcity framing triggers urgency and fear of missing out. Number 22, lead with traction, not product. Founders love showing product demos and feature lists. Investors only care about growth metrics and customer validation. We're growing 25% month over month with 95% retention beats. We built this amazing tool with cool features. Always sell business outcomes, never sell product features. Number 23, hit 3 proof categories. Every compelling pitch needs social proof: customers, press coverage, financial proof, revenues, strong margins, and strategic proof, partnerships, intellectual property. If you're missing any category, your story feels incomplete to investors. Make sure you can credibly demonstrate all three types of validation. Number 24, match investor types precisely. This is a big one. Seed stage VCs don't fund pre-revenue companies. Private equity doesn't touch early stage consumer apps. Series A funds won't consider Series C deals. Misaligned pitches waste months of precious time and kill your momentum. Do basic research before reaching out to anyone. Do I even need to say that? Number 25, show de-risking factors. Now, investors get really excited about upside, but they actually fund based on reduced downside risk. Prove you've de-risked through repeat customers, low churn rates, strong gross margins, or experienced team members. Make the safe bet aspect of your investment absolutely clear. Number 26, ask about pitch preferences. Some investors want slide decks. Others prefer Loom videos. Some like two-page summaries. Simply ask how they prefer to receive their pitches. These guys see hundreds and hundreds of decks a week. Make it easy for them. Adapting to their preferred format shows you're detail-oriented and significantly increases your success rate, which is what you want. Number 27, engineer strategic scarcity. Even if you need to raise $2 million over 6 months, don't present it as an open-ended process. Say, we have 3 allocation slots remaining, or this round closes March 15th. Artificial deadlines and limited spots create psychological urgency that drives faster decisions. Number 28, conviction over slide count. A 10-slide deck delivered with absolute conviction destroys a 40-slide presentation full of filler content in every case scenario. Focus entirely on clarity and confidence rather than comprehensive coverage. Trust me, it'll pay off in the long run. They can always get that comprehensive stuff in call number 2. Investors can feel your passion and certainty through video calls. Emotion drives investment decisions. Number 29, story before spreadsheets. Investors make their decisions with their emotions first, then justify with numbers afterward. Hook them with a compelling narrative about market opportunity and your unique position. Back it up with solid financial data, of course, but always lead with heart, then follow with head. Number 30, launch data room immediately. Set up a virtual data room from day one, please, even if it's basic. This shows investors you're serious, you're organized, and you're ready for due diligence. Most founders scramble to create their data rooms after getting interest. Big mistake. Being prepared ahead of time makes you look professional and sophisticated. Number 31, share personal mission. Include a slide about why you personally care about this problem. What's your emotional connection to the solution? Sterile, purely financial pitches get forgotten immediately. There's no heart in them. Passionate founders with personal missions get remembered and funded. Make it personal, make it memorable, make it count. Number 32, every advantage is a moat. Competitive moats aren't just patents and exclusive technology. High customer switching costs, long-term contracts, network effects, or even strong customer retention, they all qualify as moats. So show investors any competitive advantage you can, reasonably defend against copycats. Number 33, design for questions. Great pitch deliberately provokes investors' curiosity by slide 5. If they're not asking questions early, you've already lost their attention. Plant hooks and incomplete stories that make them want to dig deeper. Questions mean engagement. Engagement leads to, you guessed it, investment. Number 34, 3 metrics maximum. Investors forget most numbers within minutes of your pitch ending, or even if they get that far. Choose your 3 most impressive metrics: customer acquisition cost, lifetime value, monthly retention, and repeat them multiple times. Less is significantly more when it comes to memorable financial metrics. Number 35, prove customer demand exists. Need I say? Nothing beats demonstrable customer demand. Pre-orders, pilot programs, waiting lists, letters of intent, anything showing customers actively want your solution. Market demand always trumps founder vision in investor decision-making, always. Show people are lining up to buy and you'll get interest. Number 36, price anchor your round. If you previously had term sheet offers at $12 million post money, but are now raising at a $10 million, mention that context. It frames your current round as undervalued and creates investment urgency. Strategic anchoring works powerfully in fundraising negotiations, so keep that in mind. Number 37, record video walkthroughs. Create a 3-minute Loom video walking through your key slides. This builds personal trust and connection subliminally before meetings even happen. It's scalable, provides context, and many investors will watch these before deciding whether to take a call with you. Number 38, explain everything simply. For crying out loud, never assume investors understand your market, technology, buzzwords, or business model. Spell everything out in plain language that anyone could follow. Industry jargon and technical complexity kill investor comprehension and interest. Clear communication always beats impressive sounding complexity. 39, clean cap table required. Messy capitalization tables kills deals instantly. Delaware C corporation structure is industry standard. Founder equity allocation should be crystal clear. If your legal structure is complicated or unclear, fix it completely before pitching anyone. This is non-negotiable and should be handled up front. Number 40, follow up forever. Investors who ghost you today might invest 6 months from now. Keep them warm with quarterly traction updates, not spam. Stay on their radar consistently. Market timing changes. Fund priorities shift. Persistent founders who show progress, these are the ones that eventually get checks. Now, here are some bonus tips. This is number 41. Define investor fit filters. What does that mean? Not all money is good money for your business. Not all partners are good partners for your business. Define your ideal investor profile, check size, value add capabilities, time horizon expectations, cultural fit. Don't waste months chasing investors who aren't aligned with your needs. Strategic fit matters more than just capital. Trust me on this one. You'll thank me later. Number 42, highlight legal readiness. Show investors you've handled corporate basics professionally. Delaware entity structure, clean ownership records, proper equity documentation. This signals serious business operations and eliminates early red flags that typically kill deals before they even start. Number 43, own market leverage points. Before raising capital, secure some form of market leverage, exclusive distribution partnerships, proprietary data access, key supplier relationships, or controlled traffic sources. Investors pay premium valuations when you control strategic choke points in your industry. Number 44, close with proof. End your pitch with a concrete case study or success story. For instance, we applied this exact strategy, raised $4 billion in 90 days, and scaled annual recurring revenue by 300% in 12 months. Specific proof points beat vague promises every single time. Okay, now I just gave you some of my best advice and learnings around pitching investors and securing funding. But sometimes to get better at something, you need to actually look at what's not working and what you need to do to fix it, which is exactly what I do in this video right here, where I show you what I learned after studying over 1,000 pitch decks and the biggest mistakes I discovered that almost always prevent people's pitch decks from convincing investors. Even if you're in the early stages and haven't even built your pitch deck yet, what I show you in that one right there will be super valuable. So I will see you in the next one, and good luck out there.